With the S&P 500 testing up near 2,000, investors are wondering what lies ahead as we approach the end of the year. Morgan Stanley just came out with a new analytical piece looking at the case for maybe S&P 3000 heading into 2020 that has a lot of investors chatting about, is the situation more optimistic than possibly a lot of folks think? There are a number of big catalysts, however, that we face heading into the end of the year that perhaps investors are not quite discounting enough. So the more optimistic case, the one that Morgan Stanley highlighted in its S&P to 3000 by 2020 note, is the fact that the economy has been growing very strongly here in the United States with the best pace of job creation since the 1990s. And this is all the more impressive considering the weak performance of economies overseas such as China and Europe. We've also just now kind of returned to what would be considered a more normal level of the economy with the unemployment rate falling near 6%. But we've still seen a lack of kind of growth in the business sector with capital expenditures still very weak, inventory levels still quite low, and really not seeing the kind of excessive credit creation that typically is a hallmark of late economic cycles. So kind of add this all up, and it suggests that although the timing, we've been in a bull market here since 2009 and economic expansion since 2010, and we're kind of running up against the tail end of how long historically a bull market and economic expansion has lasted. On these other measures, such as job creation or capital expenditures from businesses, we're still kind of in the early days, and that's justification Morgan Stanley used. So the more pessimistic outlook, and one that I think that investors should be paying attention to, is the fact that we have a number of major catalysts that the market's going to have to jump over through the end of the year. So number one is the ongoing geopolitical tensions in places like Ukraine and Iraq, with reports this week that NATO is looking at sending military troops actually inside Ukraine for the first time. So that's a potential worry. We also have a number of major central bank decisions, starting with the European Central Bank, which is fighting very low inflation and very high unemployment, kind of a witch's brew, if you will, for central banking. We also have the looming end of the Federal Reserve's quantitative easing program, which is on track to end in October. And also, if we see the pace of job creation continue to be very strong, the Federal Reserve will come under pressure to raise short-term interest rates in the early part of 2015. Investors are not going to like that. We also have other issues such as potential contagion risk from weak overseas economies. I'm talking about the poor performance in places like China, Europe, and Brazil that could potentially have spillover effects into the United States. We're also seeing some weakness in the bond market, particularly in junk bonds, which have been kind of a flashpoint. Anytime that we start talking about higher interest rates from the Federal Reserve, the junk bond market kind of has a little bit of a freak out, and that's happening again now in early September. And finally, we have the approach of the very contentious, or sure to be very contentious, midterm elections in November, which could usher in a return of the type of fiscal standoffs that we haven't seen since 2012, with talk of government shutdowns and potential debt defaults, something that investors haven't had to deal with for a couple of years.